I was reading a report about McDonald's having sales down, like one of the worst sales declines in 20 years. And then I saw Bill Bodnar from Tabrasa. He was actually posting an article about McDonald's. The reason why it's important is because we're in a 70-30 economy.
Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate. So let's get started. Here's your host, Kevin Perenio.
Hey, it's KP coming to you live from Huntington Beach. I'm here at the Core Connect 2024, and let me just set the scene. CoreLogic, huge 5,000 employee global data company. They're pushing out a lot of products, releases, but this is like the last night. So they have the Paseo Hotel rented out. Check this out. Here we go. Let's go. This is a pretty good event. This is Huntington Beach. I'll give you a little look, give you some missed sunset. I almost forgot to do my video, to be honest with you. Here we go, Huntington Beach, right here. Look at that. They even have this nice graphic up there on the roof. It's pretty cool. So, not a bad gig around the entire hotel. I mean, that's what data and technology companies can do while, us mortgage companies are grinding our asses off. All right, I'm gonna give you some good data, but let me get out of the noise real quick. Let you know how. All right. Thanks for waiting for a full minute there with me. Okay, so big week. It's jobs week. It's Fed week. It's earnings week. Like 30% of the S&P 500 is pushing out earnings this week. I'm not a financial advisor. I'm not responsible for your losses, only your profits. Apple and Amazon are on Thursday. Meta and Microsoft are tomorrow. That's after market close, AMC. McDonald's was BMO this morning before market opens. And it was pretty telling. It's funny. I was reading a report about McDonald's having sales down, like one of the worst sales declines in 20 years. And then I saw Bill Bodnar from Tabrasa. He was actually posting an article about McDonald's. The reason why it's important is because we're in a 70-30 economy. So, top 30% is doing fine. Baby boomers are wealthy. Got like $79 trillion. I just read $79 trillion. I thought it was 75. About $79 trillion of net worth baby boomers have it. And people who pay their credit card down every month, are in that top 30%. The bottom 70% still has a very bleak outlook. They're paying 24% interest on credit cards and carrying high balances. And, the long and variable effects and lag effects of higher interest rates are catching up with the bottom 70%. So the Fed could totally cut this week. They're not going to because they would have a credibility problem. So they're going to wait until the dot plot and the September meeting to most likely cut. And by the way, they could cut 50 basis points. I know no one's talking about that, but they could absolutely do that. Inflation is pretty well under control. But remember, even if inflation is going up less quickly, it's still going up. And so, 2.5% or 2.6% PCE core that we saw the other day, that's still going up. And that's still hurting, especially the bottom 70%. So it's a problem. The GDP read for Q2, which was, I believe, 2.8%, there's a quarterly PCE component in there. So there is an inflation measure in the entirety of Q2. It was supposed to be expected at 2.7%, but it was 2.9%. But again, that's April, May, and June. And we know we've been getting monthly inflation reads, obviously much lower than that. So Fed statements very important. Bank of Japan, Bank of England, including the Federal Open Market Committee meeting, they're all, it's central bank week. There's a lot of stuff going on this entire week as it relates to money around the world. And on that note, something that very little people are talking about, but I talk about quite a bit, and I hope you follow me. The Treasury, the Department of Treasury, has a quarterly refunding announcement, and they say how many treasuries they're going to be selling in the next 3 months. And they kind of do it in a couple of different phases. So today, they announced what the overall number is. It's $100 billion less than last quarter. So that was helpful for the 10-year Treasury to close below 417, right at 417, 4.17. Remember, the 10-year yield is pretty indicative of where mortgage rates are going to go. The 2-year yield is indicative of where the market and institutional investors and traders think the Fed funds rate will be going. So now tomorrow and the next day, the Department of Treasury, in part of their refunding announcement, then they will say, will we be selling this many of 2-year, 1 year, 2 year, 3 year notes, 5 years, 7 years, 10 years, 20 and 30 year long bonds. So they say, what the percentage is of the overall number is for each of those yields. And so what's interesting about that is, remember, the Fed has a tri-mandate, 3. Everyone says dual mandate, but it's actually a tri-mandate, okay? It's full employment, price stability, which means, jobs and inflation, but then also to make sure that we have moderate long-term interest rates. The 30-year yield on the 30-year bond going up over time, while the 10-year Treasury comes down. That is called the bear steepening. So what is basically saying is our long-term debt deficit is more and more unsustainable. So to have a 30-year commitment from the United States, we want more yield. So if you watch the 30-year continue to tick up, that is every institutional trader and government that buys our bonds, Japan being the biggest foreign buyer currently. China was the biggest foreign holder. They're not buying near as much as Japan is right now. And of course, American institutions make up the bulk of buying. But if they get a higher yield on a 30-year bond, that is saying that we have too much debt and deficit. We're in an election year, and everyone thinks, we're going to hell in a handbasket, and our debt's crazy, and the percentage and the amount of interest rates and stagflation and I see all the comments on LinkedIn. Just don't forget, there is a revenue side to our GDP, which is, $28 trillion, something like that. Or so we're a massive economy. And all this tech that's reporting, all this AI, all this incredible AI that we saw today here at Core Connect, it's very deflationary for labor and productivity. And we're still the leading country when it comes to AI innovation. And of course, an able-bodied workforce. We don't suffer population decline due to the birth and death rate because we let immigrants come in our country. And I'm not here to debate immigration or policy or how to do it, but if people aren't having kids, we make up for that by having people come into our country, and they are an able-bodied workforce. So it actually helps housing, by the way. So anyway, lots going on. These companies that are reporting this week, Apple, Amazon, Meta, and Microsoft make up all the Magnificent Seven. Actually, they're $15 trillion of the S&P 500, just the Mag 7. That's insane. Out of the 45 trillion of all 500 companies, so it's a third of the S&P, and 4 of them are reporting in just the next couple days. Jobs week. We get the Bureau of Labor Statistics report Friday, the first Friday of the month. It's coming out this Friday, August 2nd. We got JOLTS report tomorrow morning. Job opening, labor turnover, what's the quit ratio? ADP payrolls coming out, and of course the weekly jobless claims. We have a lot of information coming out, and it's just crazy. It's a crazy week. Watch the 10-year Treasury. it could go either way. My guess is it will continue to go down after this week. Look for the Fed statements, on Wednesday, and in the press conference to be a little more dovish. My mom's name is Ollie. Some of you are old enough to know Oliver North. Have a fantastic week. I'll get back to you on Friday after the Jobless report. Cheers.
Hey, it's KP coming to you live from Corona, California. Okay, we're a little bit after, almost midnight. It's 11:40 on a Wednesday, and I normally don't put out a Wednesday video, but the Fed meeting was today, and we have Jobs Week Friday, so I know my good friends over at Zactus are going to appreciate this. They got some great products I'm going to talk about. Have a meeting with them next week. So anyway, got done with the CoreLogic event, started a new no drinking personal little thing here. I'll let you know about it here towards the end of my video. But it's Fed Day. Let's talk about the Fed. Let's talk about what was said, and let's talk about certainty versus uncertainty and stock market, which the Mag 7, the Magnificent 7, some of those stocks are priced to perfection. Have you heard that before? It is a real phrase. I am not a financial advisor. I'm not responsible for your losses, only your profits. Okay. By the way, Heather Skipworth is a former colleague of ours. She retired, and she was battling cancer, and we had this, like, our 501c3, PRMG Cares. One of the first big things we did for a coworker was for Heather. And threw this on today because I'm doing an internal video for our 1,500 employees to kind of recap month end here after I get done with this video. And then I got a message reminding me that Barry Habib who is facing a blood cancer battle. He just started today, which his video was awesome. I'm going to give those guys a hat tip on their commentary on the Treasury refunding. He is starting his final week, 6 rounds of chemo. So hat tip to Barry and everyone who's dealt with battling cancer and fighting through it and dealing with it with family or personally. So keep fighting. We love you, brother. And you too, Heather. You look great. Love seeing the videos, pictures on Facebook. Okay. Fed conference. No cut. There's no cut. But there is a cut coming. So if you go to the Fed Funds Future CME tool online, you can see that the July 31st meeting is already off the board. But there's 100% priced in chance of a Fed rate cut September 18th. And not only is there a Fed 18th 100% cut chance, 86.5%, there's a 13.5% chance it'll be a 50 basis point. Now, I watched the whole press conference today, and Chair Powell was actually asked that, would you go 50 basis points? He says, we're not even thinking that. So, I doubt we could weaken so much that they would want to go 50. Although, if you recall, over a year ago when I was starting to have to make bets and doing some research on when cutting cycles start, a lot of times the first cut is more than a quarter. It is 50 basis points or more. They could totally do it. I mean, it could absolutely do it. The real rate is crushing. It's very sufficiently restrictive, overly restrictive, especially for, anything related to interest rates and the lower 70% of our economy. I mean, it's tough right now. Anyway, so if you look at the Fed Funds tool, it also has basically the majority of the bets for the futures is that there's a quarter each of the next and remaining 3 weeks. September 18th, November 7th, December 18th. Okay, so every 6 weeks they meet. Now, there was no dot plot today, okay, which is, I think, the main reason why they didn't. Now, just to remind everyone what that is, the Summary of Economic Projections, the SEP, aka the dot plot, every 12 weeks, every other Fed meeting, all 19 members of the boards, I think it's 12 that are voting members, but there's 19 that kind of like they rotate who gets to vote and this and that. Anyway, they have to say, each one of them, like, it's kind of like revealing, there's all this, robust debate, discussion, and they've had a consensus every single time. At the end of every meeting, they've always had the same conclusion, like today, no cut. But when they have a dot plot, they have different opinions on different things, and they must put up and show out their cards, show their cards, lay them on the table. But each of them put a dot, and they take kind of like this little average where the economy is going to go. GDP, unemployment rate, inflation, the Fed funds rate, next year, the year after, this year. So we're running out of months for them to say. So they're going to have a dot plot September 18th and another dot plot to end the year, December 18th. And as of right now, the market thinks there's 3 cuts. I don't know. I think labor would have to weaken maybe a little more. On that note, we had the job opening JOLTS report this week. Just over 8 million job openings, came down just a little bit. Jobless claims comes out every Thursday. We'll get another read of that tomorrow. It's been, a little higher, but pretty stable. 4.1% unemployment. Chair Powell said unemployment rate has moved up to 4.1%, but, quote, remains low. So he called that low. Even though the dot plot at the last dot plot meeting back in June, they all said, hey, unemployment will be at 4.1% by the end of 2024. Well, we're there in June. So, obviously they wish it wasn't what it was, but, it's still, we have a very healthy economy. We are at pre-pandemic levels for a lot of different things, including inflation. And so they're obviously watching labor and inflation, kept talking about, both those points for their dual mandate, although they really have a tri-mandate, which is to keep moderate long-term interest rates controlled out, like the 30-year long bond. Okay, so it was very interesting in the press conference. Not quite at that point yet was another quote about cutting. And Claudia Sahm, the Sahm rule, S-A-H-M, her rule was, I connected with her on LinkedIn. She's got some great content. She even had a CNBC live interview right before the Fed press conference. So Chair Powell mentioned her Sahm rule and said that it is a statistic regularity, is what he said, statistic regularity, showing that, it basically means like if the unemployment rate goes up a half a point within a 6-month period, I believe is the rule, that's usually an indicator, a statistic regularity of a pending recession. So we've gone from 3.6 to 4.1% in less than 6 months. But then he said, hey, the 10-year, 2-year Treasury yields being inverted, which almost always means there's a recession. He said that's been flouted, he said. And then he went on to say, this has been a supply chain driven inflation problem. And so this is a one-off, is what he's calling it. It was interesting because he said at the end of last year, we had 7 months of good inflation data coming down, but he said that was mostly because of goods inflation. Whereas this year, especially the last 3 months, we've had both services, non-housing services inflation come down, and housing services inflation come down. So he's saying they've all been coming down in inflation. When asked about, what happened the first 3 months of the year, was it just seasonal? Can you just throw that out? He said, well, even if the inflation that spiked up, because remember in December 13th, the dot plot, and there's going to be 3 rate cuts this year, and inflation was coming down. All of a sudden, January, February, and March, inflation spiked up, and he chalked that up to being seasonal and said that's why we look back 12 months, you smooth out the ups and downs, the peaks and valleys, and you can see, which he touts, the PCE. That was the only number he talked about. Didn't even talk about the CPI pretty much the entire press conference. He said our personal consumption expenditure, the PCE, the 2.5% year over year, and 2.6% core PCE, which is their preferred number, stripping out energy, oil and gas, energy, food, those kinds of things. So, by the way, oil prices have been coming down, even in light of all this crap going on in the Middle East with these rocket attacks, and now Hezbollah is trying to do a little end around here, and they killed a bunch of kids on a soccer field in Israel. So Israel strike back in Lebanon. So oh my gosh, oil's coming down as opposed to spiking up when there's typically geopolitical tension in the Middle East because maybe they think there's more recessionary issues coming in the future. So oil coming down is a big win for taming inflation, just FYI. Okay, so the dot plot gives them cover. They're kind of coalescing. They're bringing certainty. But you know what? The Treasury refunding is kind of like a 3-day announcement where the Department of Treasury, Janet Yellen, says what they're going to do. I mentioned on Monday in my video that $100 billion less Treasury is being sold in this upcoming quarter. And then they also said they're not changing like the duration, right? So they've gone like a little bit more 2 years and 3 years and 5 year, bills and notes, as opposed to maybe like a 10-year or 30. Like why sell a bunch of 30-year, 10-year, 20-year treasuries when the rates are, they pretty much just peaked and now they're going down, especially if you believe that we're about to go into a Fed rate cutting cycle. So let me just zoom out. I'm going to talk about how this is very important for earnings and balance sheets for mortgage servicers. It's a big, big deal. But remember a year ago, inflation is not going away. It's entrenched. It's here forever. Go buy gold. We're going to have 10% interest rates and a 6, 7, 8% 10-year treasury yield. All those people were wrong. They were wrong. If you remember who they are, just be careful about them. Now, I get it. People get caught up in their feelings and the moments, and they don't really look at the data and don't have patience. And I'll be honest, like I even got a little hopeful, if you will, that we would have Fed rate cuts. Of course, because I want lower rates. I did not expect January, February, and March inflation to spike up like it did, but here we are. It looks like I'm going to be off by like 12 weeks. Maybe 18 weeks. 3 Fed meetings on my Fed rate cutting cycle. It's a big deal though. Look at the 10-year treasury. It is a big deal. Servicers of mortgage servicing rights, MSRs, will now have to mark down the value of their balance sheet as interest rates come down. Okay, now I had this thought because I looked at Fannie Mae's earnings that came out for Q2. They made $4.5 billion. Good for them. $4.5 billion net on like $96 billion of liquidity providing to the market. There's some multifamily in there, but about $86 billion of that Q2 liquidity they provided was for conventional single-family residences. And $11 billion of that was refinance, and the rest was purchase. So let's call that $75 billion, half of which is first-time homebuyer. Now, we buy and sell money. We put portfolios on our balance sheet. We're not a huge servicer. We got rid of most of our servicing. We love cash, especially when you have no idea how long the rainy days are going to last. But servicers, especially ones that are public, you can see what they have to do because they have to report their earnings every quarter. Now, there's different levels of being public, like 7% of the company is public, 100% is public. Different risk factors there for a company. But any smidge of a public company that had to tap the public markets and go public for stock to raise money, every quarter must show their cards. And when rates go down and the 10-year treasury goes down, the value of mortgage servicing rights and those servicing portfolios tends to go down. So hopefully they can make up for it with more originations because rates are going down. And so what you typically see is to offset those future losses of their balance sheet coming down, taking a paper loss, marking down the value of their servicing portfolio. They like to gobble up and maybe put out better pricing so they can bring in more deals as rates are getting better. Something to watch for, especially when July, August, and September Q3 earnings are reported by all these banks, servicers, credit unions, REITs, non-banks alike. Be interesting to watch that. It's slower this time of year, although we just had a great month. So we're kind of a bellwether. We've got 3 channels. We serve originators however they want to be served. And they want to be served right now. We funded like $850 million last month, just closed out today. Took it about $1 billion of locks. August looks great going into August. And so September's typically slowed down. It's also kind of a smaller month. School starts. People aren't shopping as much. So there's a lot that's going on. Okay, let me talk about the stock market really, really quick. So when I say price to perfection, Google got hit the other day because their ad revenue, it was like $8.64 billion in 3 months for YouTube ad sales. They did, that was the actual number. The expectation from the market and analysts was 8.8. So like less than 200 million they missed. Stock got crushed, after hours, right? That's being called price to perfection. You can't like mess up. Meta today, perfect. Like knocked it out of the park in their earnings report. All these, magnificent 7 stuff. Microsoft just barely missed on their Azure cloud revenue, and then guided down in like a future quarter. Stock got punished. But then the certainty brought with going into a Fed cutting cycle, brought a lot of money flowing into the stock market. And some of these businesses I just named, They all caught a bid today because they're great businesses, have good free cash flow. And if yields are going down, you're making less in bonds. Stocks and bonds typically trade opposite each other. Hope you have a wonderful week. I'll be back Friday from hopefully a beautiful place in Newport Beach talking about the jobs report. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.